This is a solid brass bowl. And this is another brief, entertaining discussion where we're going to call bull on yet another one of probably technical analysis greatest fiascos, Elliott Wave theory. So if you've read a lot of books and you're trying to surf the wave, you're going to wipe out. And that's exactly what's going to happen. And by the end of this video, you're going to understand why. Hi, everybody. My name is Frank Bunn, and I've been teaching people how to properly analyze financial market data for longer than I can remember. Let's get right to it. Elliott Wave was developed, I don't know, 60s or 70s or wherever, by this guy by the name of R.N. Elliott, who was not a trader, who also filed bankruptcy at the age of 58 and wrote a lot of books. Well, he had this idea that, you know, you could take a look at financial market data or price history, and it will move in waves. And specifically, the wave theory, as he postulated, was A, B, C, D, E. So what he had was wave A, B, C, D, and E. And that by analyzing these waves, and depending on which leg the market was in, somehow that this would, you know, forecast future market behavior or market prices. So right away, you know, I don't know, just because it's in a book, some people believe it, but right away you can see the issues with this. Where does A start? Where does it end? How long is it? Financial data is depends on its time frame, and he supposedly studied 1 minute charts all the way up to weekly and monthly charts, and was able to establish this theory. All of it, though, in hindsight, none of it actually with any forecastable, if you could say, value. None of it could be modeled. And what's really interesting is there's no real definitive. Actually, it can't actually be said that he actually traded. He was an accountant and a dabbler. So there's really no suggestion that this was ever used. The problem with this, again, just like anything else, when we understand market dynamics and we understand cycle flow from expansion to contraction and contraction to expansion, we can see that although in theory prices might move in waves, you still have to understand the price action. So this, let's call this the war, and in here this is the battle. And the battle is won with very specific recurring price action footprints in these areas of congestion and expansion and contraction, where we can see the footprint of price and what it's doing and how we can model that in order to make profitable, consistently profitable directional trades. Okay, here's the issue, and this is the thing that very few people understand. When you take a look at how prices move, everything in real time is real time. It's happening right now. A price chart, historical price chart, is worthless because everybody that was making these trades in the past may not be here at this moment. Therefore, price has to be fluidly and in terms of flexibility and fluidity, has to be analyzed on its own merit at these particular price points so as to forecast, you know, what is most likely to happen. So you can very easily see that taking a look at waves and expecting the wave to, just because we have A, B, C, and D, so this D, now right here something magical should happen so that we get an E wave, discounts everything that is known and viable about near-term price action analysis. What exactly is going on here? The price action in this could easily be forecasting a down move as instead of the up. The Elliott Wave theorist, the Elliott Wave practitioner will never understand that. So this is just a bust from the door. Okay, so there was another guy, unfortunately, a dude by the name of Robert Proctor. We'll call him Bob. So Bob Proctor in the 80s found what Elliott was doing, and he decided, what do we got to do about this? Well, let's not trade it. Let's not make a fortune. Let's write a whole lot of books. So he's written somewhere around 14 books on stock and market analysis. Again, there's no suggestion that Proctor ever traded or ever did anything, much like Charles Gann and the Gann lines back in the 50s. His descendants claimed that, he retired, he died broke actually, or retired broke. So anyway, Proctor, and just to give you a better idea about how much bullshit is actually going on, the UK Association of Technical Analysis gave this guy a Lifetime Achievement Award. All right. So anyway, Proctor continued this, continued the whole notion through this whole series of books about Elliott Wave and its forecasting ability. Again, all based on historical data. All right. So what you find out is, again, historical data is largely worthless. What happens is when you learn to analyze price properly, you have historical data, and then it separates the chart or the data or whatever into two sections. All right. So this is called the static. And over here, the hard right edge, this is dynamic. Exactly. So when we move from the static to dynamic, that's where we need to understand exactly what price is doing in the here and now. That has nothing to do with historical data. That's why technical analysis is largely bullshit and indicators that are worthless to model. All right. So with all that said, let's take a look at a real quick look at someone who was actually able to amass a fortune doing this. And it was a guy by the name of Munehisa Homa, okay? And this cool dude was a Japanese rice trader, okay? Originally from Sakata, and he traded on the Osaka exchange in the 1700s, all right? Now, they were able to use, he had actually at one point, he had people placed every 6 kilometers in Japan, between Osaka and Sakata, so that he could get exchange, release, disseminated data as quickly as possible. So he and his cohort were able to corner the rice markets using what? Price action. And he is the grandfather of modern price action analysis because he developed, that's right, the candlestick. Okay, what is the candlestick chart based on though? It's the range, a high, and a low. Aha. Now what do we have? We have something decent there. It's called price action. So legitimately, by the end of his reign, his system had amassed in modern dollars approximately 100 billion. So this guy understood price, understood the near term, understood the dynamic versus the static, and how to take advantage of it. He gained a huge edge by just all he did was study the highs and lows in price. It's that simple. Let the people who write the books tell you that it's a lot more difficult than that. It's not. So that's the end of Elliott Wave. Don't waste your time on it. What you do want to spend your time doing is learning how to analyze price behavior and near-term price action. And if you're really interested in doing that, hit me up. There's a link below this video. You can join my free training and we'll get down to it. And you too can become one of the few who really cracks the code and trades for consistent profit. Thanks everybody. Have a good day.